The cyclical nature of real estate often plays nicely into the hands of those looking for sound bites to describe market conditions. 2007 boom, 2009 bust, 2010 recovery. This year, it's proving more difficult to sum up the real estate markets of Asia Pacific in one word. We have mature markets like Japan and Australia feeling the economic effects of one-off shocks to their markets caused by earthquakes and floods. Gateway markets like Hong Kong and Singapore, which bounced back in 2010 and may be pausing to catch breath. And China, India and most of Southeast Asia still motoring along quite nicely, but with their governments rapidly tightening policy to control inflation. All of this against a background of economic horror stories from parts of North America and Europe. Perhaps the best way to maintain confidence in Asia Pacific would be to ban the Financial Times, Wall Street Journal, Economist and CNN from these parts. There are, without doubt, many uncertainties in the world, but what I am certain of is that our 20,000 staff in Asia Pacific are incredibly busy helping our clients to do business everywhere across the region, evidenced by our record ever revenues in Q2 of this year. In the last 3 months, we have helped American private equity buy into Sydney offices, a global company sell prime land in Delhi, a high net worth Indonesian individual buying into prime London for $500 million US, a Canadian pension fund buy into Melbourne retail, a Japanese fund buy into Vietnam, a Korean retailer buy into Jakarta, and a host of other capital markets transactions, including selling 300 residential units in Macau in only 5 days for about $180 million. Our ability to connect local and international markets is proving invaluable to our clients. We've also helped landlords and tenants with their business needs, transacting around 11 million square feet in the quarter, everywhere from Chengdu to Bangalore and Adelaide to Seoul. Some of our achievements include transactions in Singapore this quarter amounting to over 500,000 square feet of office space signed for tenants in 3 separate deals. In Jakarta, we advised on a retail leasing deal for over 840,000 square feet. And in Hunan, we've recently been appointed joint sales and leasing agents on the 4 million square feet Shenyang International Software Park. Our managed portfolio in Asia Pacific has grown to 850 million square feet as clients seek to maximize efficiencies and returns. And in this unpredictable environment, we are also advising on hundreds of strategic property holdings, from the future of the Shanghai Expo site to the potential redevelopment of the Hong Kong Jockey Club, to the real estate assets of this year's largest IPO to date, Shanghai Pharmaceuticals. So despite the mixed economic messages, there's plenty of activity going on. Our occupier clients are telling us that they want to grow their businesses, but they want to grow sensibly, without ratcheting up their cost base too much. They want to maximize their productivity, and they want to take smart real estate decisions. Our investor clients are no longer looking for bargains, but they are looking for value. And they appreciate that the real estate river may look like it flows in one direction and at one speed, but in reality there are various pools and eddies and back currents to be navigated. While, as always, there will be bumps on the road to recovery and periods of reflection, it's hard to bet against the fundamentals of demographic forces, economic growth and tenant demand and their positive effect on the real estate markets of Asia Pacific. My feeling is that if we had to have one word to describe the second half of 2011, it would be busy. I'll update you next quarter.